Okay, good afternoon, good morning. It's actually Saturday, August 20th. I just had a little bit too much on my plate Friday afternoon and didn't have a chance to get to the weekly video. I know some of you emailed and DM'd me on Twitter, I guess is what you would call it. Apologize for the delay, but I just didn't have time. So thank you for your patience. This is the weekly take on the market. I'm your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investor Business Daily. Here is the disclaimer. Take a moment to read this, please. We are not licensed at IBD. Okay, so we'll talk about the markets, the indices, some charts that I've come across my desk, so to speak, this weekend, or this week, I should say. And then we'll get into the industry groups, stocks to watch, quote of the week, you know the drill. It's always the same, pretty much. So here is a chart of the NASDAQ. And Friday, the market was down, had kind of a rough day. Although the volume wasn't up, which is surprising to me. It did not qualify as a distribution day. That's a little surprising that the volume didn't pick up. I think it was a options expiration, maybe just a normal options X. So the market kind of did what everyone expected. It got close to this 200-day moving average. It's come in a little bit. Natural. I don't read a whole lot into the last couple of days. I think this is good, actually. If you're bullish, this is really good because you really want to see how the market acts with a pullback, some type of sharp pullback, some type of shakeout. If it's bullish, it'll come down a little bit. I don't know what a little bit is. Is it all the way down here? Is it worse? Is it less? I don't know. If you're bullish, it's got to hold these lows, of course. I would think that probably some kind of declining trend line like that, it should hold. It's a lot of room down. But you've got the setup that you want. And if it can go down to sideways for a number of days, that'll help to build some handles. There's a lot of cups out there, I've noticed. So a week or two down could help to create some cup with handle patterns and then give us some potential setups. The S&P is holding up a little bit better. It actually got to the 200-day, almost to the penny, it looks like. You did have a distribution day on the S&P 500. So, but you've got like this trend like this. This is pretty steep trend line like that I drew. So you've broken the really steep trend line that was up. So the market's lost a little bit of momentum is probably what a lot of us have noticed. I don't think I've mentioned the Russell in a while. Let's look at that. So you've got this trend, you got the really steep one, and they almost all look the same. The Russell got a little bit above the 200-day. So it's really, the NASDAQ is the weak sister. S&P Russell is leading a little bit, just a little bit better than the S&P. But the main thing is the NASDAQ is the weak sister. For a couple of weeks, I've been long the S&P, short the NASDAQ. It's almost an experiment just to see. And for every 10 units long of the S&P, in general, I'm short 6 NASDAQs. So it's not a perfect one-to-one. It's more on the long side because I feel like the market was going up. Rather be on that side, but let's put a little hedge. Let's see how that can work. And it's worked a little bit so far. It's the problem with hedges is when the market's going up, you lose on your hedge. And so you're like, well, I don't want to be hedged. I want to be long, but then you get a few days like last few days, and that's why you have the hedge. So I've just experimenting just to see, because I've noticed the NASDAQ is much weaker than the S&P, and normally the NASDAQ would lead. It's got the best growth stocks and stuff, but it did not reach the 200-day like the others. It went down more than the S&P, which is almost always going to be the case. It's going to go down in a bear market more than the S&P. Can't think of a scenario where it wouldn't go down more than the S&P. I wonder if there is a bear market out there where that's the case. I guess it's possible, but unlikely. And then the Russell is, hanging in there. So I don't know. The jury's still out on the overall market. I would say if you're totally flat, if you're 0% invested, you're doing it wrong. And if you're 185% invested, you're doing it wrong. Unless, I guess the only thing I would say is if you're just killing it on the year and you've got the gas pedal on, you want to be 185%. That maybe in that case. But if you're just having an okay year, up or down tiny bit, or even up pretty good, it just doesn't seem like the kind of environment where you'd want to be way out there on margin. You could possibly be out there a little bit, but unlikely. So it's just kind of in no man's land is where the market is, unfortunately. I really, and I've said it a few times, I would like to see this do something like this. It doesn't have to be like that in one day, a number of weeks. I want to see how it handles some kind of pullback. And then the next leg, whether it's up or down, will tell the story. So that's really what I'm waiting for, to get aggressive to the long side. Although I do have some longs, but all my longs are kind of in the same industry, same energy area, energy, materials, and they act very similar. So, one oil stock or 3 oil stocks. There's no diversification. You guys know that, I'm sure. Okay, so that's the indices. A couple of charts that came across my desk this week. Margin debt has collapsed. It's very interesting. I could make either side. I could argue either side of the case for margin debt. You need margin debt to fuel a good bull market. You can see the margin debt increase after the 09 low down here, and then as well in 2020 after the COVID crisis. It got extreme in 2020. It's probably not adjusted for inflation or anything like that, but you can see when margin debt gets really extreme, it's kind of it's a chicken and egg thing. So it's not that the margin debt is extreme, therefore the market's rolling over. I really think what's happening is the market is so good, people are doing so well, they're feeling more comfortable, they're exuberant, they're adding margin debt, they're constantly adding. Of course, that's the time when you want to be taking off. The market has a natural ebb and flow. It cycles. Can't be great forever, can't be terrible forever, which is good too. So the margin debt, when it peaks like it did in 2000 or late 99, peak in 07, really when you see probably the key is when you see that kind of change in trend, that's probably a good sign. So you can see the change in trend on margin debt when it's really started to go down in late 20, early 21. That's your clue. Once it peaked, made a lower low, that was your clue that the market wasn't in great shape. So we're really extreme to the low side, and that will probably snap back. Might take a few months or whatever, but that's usually how it goes. FANG revenue, AA. I assume, when you add, there it is. It's Facebook, which is now Meta, but Mang doesn't sound as good, right? Facebook, Amazon, Apple, Netflix, Google, revenue growth, very interesting chart, negative for the first time in almost 20 years. Their combined year-over-year revenue growth. I think that FANG is, I don't know if dead is the right word, because they are great companies, Apple, Netflix, Amazon. These are all companies Google will all keep using, but there's an economies of scale. There's a price that no matter how great the company is, there's a price that's too high. And no matter how poor the company is, barring bankruptcy, there's a price that's too low. And so these companies, these stocks have gotten just kind of too big, too waterlogged. And Apple's holding up great. Google's okay. Amazon's okay. Facebook's not great. Netflix broke down. And it just doesn't seem like a place for capital, which is why new bull markets will have new merchandise. it's kind of the way it works. Clean sweep broom. And it's always been the case. Very rarely do companies lead in more than one cycle. It's not impossible. Apple has been a great leader in more than one cycle, like the 04 to 08 cycle and the 09 to, I don't know when you want to call an end to that cycle. Apple's been right there. Netflix was there for a while until it stopped. But usually it's going to be new. And all the stocks that show up on my screens because of relative strength and earnings and sales and all of that are energy related. So maybe that's the area. I don't know. The problem with energy is there's hard to distinguish XYZ drilling from ABC drilling. Now I know there's differences. The region they drill in, it can make a big difference for sure. But mostly my feeling is when I own these types of stocks, I own 4 or 5 of them, and it's either a good day or a bad day. It's very rare that 3 are up and 2 are down, or vice versa. But this looks tired to me. This is not an area that I would go to for leadership, which is why the NASDAQ is struggling. Because those 5 companies, I don't know the number. I would bet it's at least 35% of the NASDAQ, maybe more. Maybe I'm underestimating. I guess I should have looked that up beforehand, but I didn't. So that's my guess. Over under 38%. I'm going to put it at that number, and you guys can kind of guess what you think it is, and then look it up. All right. Chart of the day. National Association of Active Investment Managers. You can see in May, June, July, they're very underweight their exposure. No surprise, market rallied. Now they've increased their exposure. It's the cart pulling the horse. Lower prices in the market lead to more selling, more people willing to sell, more people willing to take a lower price until it reaches an extreme. Higher prices, you see with the margin debt, lead to people willing to pay even more and buy more and buy more. It doesn't work like any other market in the world. It's why we preach adding on the way up and cutting losers rather than dollar cost averaging in stocks. Because what happens when you dollar cost average is they can go lower and lower and lower. And if you reverse it, if you dollar cost average on the way up, I was talking to a friend just a friend of mine that he likes to buy on the way down. He was telling me he had an order to buy Ford at, I can't remember the price. It's irrelevant. It doesn't matter. But let's say 10. He was going to buy 100 shares at 10. And then he had another share at 100 at 8, another at 100, 200. Oh no, he was stacking. He was 200 at 8, 400 at 6, 800 at 4. And he was just going to buy it all the way down like that. And I was trying to explain the flaws in this process. But it's Ford. It always comes back. And I would say you're right, 99.2% of the time, but 0.8% of the time, you're going to go broke. You're going to go broke doing it that way. Why not buy? And what happened was it stopped at 10 or wherever, and he never got any of his other buys. And he was lamenting the fact that he had 100 shares only in it. The stock had, let's say, doubled. And I was trying to explain, well, what if you had done it the opposite way? But instead of 100, 200, 300, 400, 800, you bought 100, 75, 50, 20, 10, every point it went up. So you bought more at 11, you bought more at 12, you bought more at 13, you bought more at 14. And your risk is so much less than the way that he was planning on doing it before. Your risk is you're going to get too heavy on the way up and give back all your profits, probably, if that's the risk in a scenario like that. But got to 15, now you've got a big position portfolio-wise, and it breaks back down to 10, you've given back all your profits. I understand that. That's no fun. I don't like doing that either, but that sure is a heck of a lot better than having 1,600 shares at an average of 8, and now the stock is 4 and overburdened with debt and maybe going bankrupt. And I'm not saying that that's the case for Ford. This is just an example. But think about like Bed Bath and Beyond. It looks like to me like they might go bankrupt. So if you did that all the way down at 25 and you bought more at 20, you bought more at 16, you bought more at 12, and it looks like it's indicated at 9 for Monday, you're gonna buy more at 9, and you're gonna buy more at 5, and then what happens if they go bankrupt? You just a terrible, terrible strategy. It works every time but one, and the one time it doesn't work, you're gonna lose a lot, if not all of your money doing it that way. So the moral of the story based on this chart, how I kind of got off on that rant, was buy more on the way up is the correct strategy. But you have to remember that that's how these guys are moving big money. And once that big money is kind of positioned, then the market has a natural ebb and flow the other way. Here is AAII. They are the most bullish they've been for 2022. And, now it's not super bullish, but it's the most bullish they've been for 2022. I would argue that the market looks as good as it's looked all year in 2022. Even though the price might have been higher earlier this year, it was on the way down and the market felt really heavy, right? So right now, as we sit here, the market feels better. So people think, oh, it feels better. It's okay to be more invested. Can't go on how you feel, which is why Bill would always say rules. You're never going to feel good at the bottom, and you're never going to feel concerned at the top. You're always going to feel like it's going to keep going higher and higher and higher. So these are things that I watch just to get an idea on where people positioned. They are secondary indicators. I've mentioned before, Charles Harris has said he's overused or overplayed his hand with these this year, but he's made a pretty good living playing his hand with these types of indicators for years and years and years. So they work a lot more than they don't. But these are things I like to look at, trying to give me an idea on where people are positioned. All right, so let's open up the industry groups in MarketSmith. So open stock ideas, weekly review, 197 industry groups. Let's pull this up. Let's start at the top. Energy solar, number one. Enphase, they've been hanging in there. Oil, gas, royalty trust, number two, still. Biotech, 3, moved up a little bit. Energy alternative other lost a space. Retail super mini markets, I don't know, it's just not really that interesting to me. Telecom, fiber optics, Clearfield, I wish I'd gotten that one, missed it. I did try that one time, it didn't work. Media periodicals, it's just, didn't you hear that story a lot? I hate telling that story because it's like, it didn't work, but then go to it the second time, because the odds are the second time or the third time it's really going to work. If a stock keeps setting up, it wants to go higher. Something might just be wrong at that very moment. But yeah, that's Clearfield. It was medical, telecom infrastructure. So let's just quickly do, what would I do 3 months ago? I'm gonna look for a large number, 103.56 for telecom fiber optics. How could you have found Clearfield? 103.70.37, something like that. Better look at that group. Double click the group, pull up the chart, and when the group started doing this, let's go to Clearfield's chart. Voila, Clearfield breaking out of a base at that point. Earnings and sales, RS of 99, just a flat out swing and miss. That has to be bought. That has to be bought. Where did I buy Clearfield before? I don't think it was here. I think it was maybe here or here, and it didn't work for me or something like that. I can't remember. I did try this earlier, and it didn't work. But setups here, and it's up 78% in 32 days. You got to take that setup. You just got to keep trying it. You got to keep trying it. I'm talking to you guys and talking to myself. Let's pull these back up. Oil and gas transport. I own some stocks in that area. It's currently 17. Utility. So go through there, those. It'll really help you to kind of get in front of a potential idea, like computer software design. 174, 42, 34. I will look at this group. I don't know what's in there, CDS, CDNS, that type of stuff. Yeah. So these are the stocks in the group, and I'll go through there and see if I can generate an idea. I might already have an idea there, but I might want to look through there. So that's really how you play the industry groups and stay on top of the rotation. And it takes about a half hour each Sunday. Because next week, if I look at the computer software design, I don't need to do it again. I'm not gonna, beat that drum over and over. If I've already looked at it. 6 months from now, it might be different, but week by week. Okay, so what are some stocks that we want to look at? There's so many. There's a lot of potential names, a lot of things that are working. Oxy was one that jumped out at me. I think the street thinks that Warren Buffett he's basically going to own this company because he just keeps buying. But earnings and sales, right? Look at these earnings and sales last 4 quarters. Stock goes up, although that didn't work. Stock goes up, stock goes up, stock goes up, at least for a day. Earnings and sales, it's what drives these stocks. Apple and Google and Fang and Amazon and Facebook, they don't have this anymore. Let's go to a weekly chart of Facebook. And I keep calling it Facebook. I know. When did it top? It topped in late 21. So in late 21, what do the earnings and sales look like going into late 21? Really, really good. Right? I mean, they're accelerating for 4 quarters in a row, accelerating earnings and sales. It's a great case study. Stocks will often top when the earnings and sales and the fundamentals look the best because the market is looking forward. 4 quarters of earnings and sales. What did the market do? It got in front of those, right? The stock went from, and I'm just calling, the low, but 135 to 340. That's a lot for a big company like Meta, Facebook. Then what happened? Well, look at the earnings and sales now. -5, -18, -30. It's reversed accelerating, right? 27 -1. What's the stock do? It anticipated all that and went down. Now, maybe it does this. It turns around and comes back the other way. It's possible. It's not impossible for that to happen. But if it does, hopefully there'll be some kind of setup, some kind of double bottom or some kind of flat base, or worst case, I would say, is at least wait for it to go above the 40-week moving average. I don't think you want to own any individual stock below the 40-week moving average. That would be like my line in the sand. Someday, maybe if I develop super patience, but look at NVIDIA. If you bought NVIDIA in the COVID breakout and you just said, I'll hold it until it closes below the 40-week moving average, closes below. I can't tell. It doesn't look like it. No, very, very close. Sits on it. Tries to go below it, holds up. Tries to go below it, holds up. Closes below. All right. I think that's your sell signal and you're out there. You're out at 210. Of course, it's never going to be perfect. Runs to 260, but now 210, 220 looks like a great sell. So I think if you're going to own them long term, then you just use this 40-week moving average in a close below. That'll keep you out of trouble on something that's going to get really bad. like a Netflix. If it's going to get really bad, it keeps you out of trouble. PayPal, let's see how that did below. Look at that. Just, gosh, it just keeps you out of trouble. I know there'll be some false signals, false signal. Boy, that's no fun. False, although I don't know if I'd call these a false signal if you sold it, but you had to buy it back a little bit higher. At least you avoid the heartache of these really bad breaks below. So this is a good, and I think of this the same way in the markets. I just think if the index is below the 40-week moving average, it's a bear market. So we've been below the 40-week moving average for 2, 4, 6, 8, 10, 12. I'm going to guess 24 weeks. It's a bear market. It's kept you out of trouble for 24 weeks. It kept you out of trouble for just a few weeks. Oh, it was it's just a little headache. Get back in. Kept you out of trouble for 8, 10, 12 weeks. You always get back in. And look at how it tends to, if it's good, it trends above that line so well. So you're out for small periods of time and in for long periods of time if you just use something that simple. Let's go back to stocks to watch on semiconductor. I don't own this. I was watching it. I was even short it here, thinking it was going to go down. That was a great buy that I made when I covered it. It should have went long. Up a number of weeks in a row, acting really good, and relative to the group, acting super good, because the NVIDIA's, a lot of the Intel's, a lot of the semis are not acting all that great. What else? Schwab is another big fish that got away, acting great. Just no place to buy it. I think I might have talked about this last week. Sometimes there just isn't going to be a place to buy it. You kind of have to just buy it. And most of the setups are, oil and gas, Matador, AR. I think I might have already talked about this. Shippers are acting great. TNK, I do own this one. FLNG, I do own this one. They're holding up pretty good. So those are the areas that are holding up till they're not. And I don't know. I don't want to try to predict that the FANGs of the world are going to change. Okay. So the quote of the week is, I don't remember which one I chose. Oh, I do remember now. Paul Enright, managing partner at Kranos Capital, on a podcast. I think this is on a podcast, or maybe he tweeted this. I can't remember, but I did listen to him on a podcast. The best analogy I can think of for being a great active portfolio manager. Imagine a baseball manager was allowed to reorder the lineup during the game whenever he wanted. I really like this one. I like the baseball analogy in investing too. I've talked a lot about it. You can be wrong 7 out of 10 times in baseball. If you bat 300, you're wrong 70% of the time, and you can be one of the best players in baseball. If of those 3 out of 10 times you get it right, you're driving in runs, you're getting doubles, triples, home runs, you're walking a lot, things like that, getting on base, scoring runs. And so imagine if you're the baseball manager in a key spot, you can bring Aaron Judge batted 3 spots ago, but that doesn't matter anymore. You can bring him back to bat again. Or Mike Trout or Ohtani with the Angels. That would be awesome. How often would Ohtani bat? How often would Aaron Judge bat? Instead of 4 times a game, or maybe 5, it would probably be 6 or 7 if in certain circumstances. And that's the same thing with your portfolio, is you can have more of the ones that are doing really well. You can add to those. You can have larger weightings in those. You can have 15% of this one if it's doing really well. 5% of that one, it's not doing that well. I like the name, but it's not doing that well. Okay, maybe I'll reduce it to 5, or whatever your percentages are. But you're allowed to do that. You can reorder your lineup anytime you want. You want to give more money to XYZ, you can do that anytime. And I do that a lot. I might not be that much, but I'm always trying to find spots to put more money with the ones that are working. I could have a few thousand shares of FLNG, and I might go in there and just buy 200, just because I want to just buy a little bit more. I want to have a little bit more of the one that's working. So this is a great quote as far as how you can manage your portfolio in that same way by reordering your lineup, having more of the ones that are working, less of the ones that aren't. Okay, contact information, Marcus Smith at investors.com, 800-424-9033. Thank you guys for your patience. I will get this over to the video team and hopefully they can get this uploaded ASAP. But we will definitely get it loaded to the website. Have a great weekend, everybody. Bye-bye.